The United States of America is a great nation, founded by great men, but it is now headed for another crisis, while we seem to be closing the door on the past. Many of our leaders have abandoned the principles that built this nation. Today, we now live in a total surveillance state, thanks to NSA spying. To the politicians who let this happen, the Bill of Rights means nothing. But you cannot have private property without privacy. We were a nation that was once proud of hard work and strong families. We had close-knit communities. But today, we live in an economy that causes many families to struggle, and in a culture obsessed with attention and materialism. The people of today care more about what they own than what they do. At the same time, they have lost confidence in the institutions of government. 2/3 of the people do not even vote. The productivity of the American worker is dropping. Over the past 8 years, the willingness of Americans to save for the future has plummeted. And the people as a whole have yet to recover from the crash of 2008. We are told that there is an economic recovery, but there is no recovery. As you know, there is a growing disrespect for government, the police, the news media, and other institutions. This is not a message you will hear in the next election, but it is the truth, and it is a warning. These changes all did not happen overnight. They happened over the past 20 years, with years full of shocks and tragedy. These were years of financial turmoil and windless wars, and years of incompetence on the part of this nation's leaders. And in the next 5 years, we will witness another crisis that will ultimately determine the course this nation will take in the future. Now, it is true that during the past 6 years, we have witnessed a bull market in the stock market that has made those invested in stocks feel rich, and it has made them happy. But like all bull markets, it has come to an end, as the stock market is now at a tipping point. The last bear market was associated with a drop in real estate prices. Investors discovered that the banks that owned mortgage-backed securities were insolvent, so the stock market crashed in 2008. This next bear market that will play out over the next few years will be associated with something bigger than a drop in real estate prices. It will be linked to a busting bubble in the world bond market and lead to questions about the solvency of the federal government itself. The future will be determined by how we react to this crisis as a people and as individuals. Hello, my name is Michael Swanson. I created that clip you just saw the past few moments. I run the website wallstreetwindow.com, and I've written several books on American history and trading, the financial markets, and investing, because in a former life I co-managed a hedge fund for a couple years. Now, as someone who deeply appreciates the principles that were behind the founding of our nation, and as an investor, I'm deeply concerned about the future direction our country is going in. Spend some time with me and let's take a trip together so I can show you exactly what I'm talking about here. Let me show you something. I'm passing through Dillon, South Carolina. You might be wondering why I want to show you Dillon, South Carolina. It's just a small town of less than 7,000 people in a county of 32,000. There are lots of places like that all across the country. The town of Dillon, though, lies right off Interstate 95, which is one of the main roads on the east coast of the United States. It starts in New England and goes through Boston, New York, DC, and all the way down to Miami. If you've ever driven down it yourself and gone into North Carolina, once you continue south and approach South Carolina, you'll remember seeing signs for a tourist trap called South of the Border. Well, that's right near Dillon. Here is Dillon on the map. Dillon is the childhood home of Ben Bernanke, and he waited on tables at South of the Border when he was a kid. He played in the high school band and was class valedictorian. Then he left Dylan behind and went to Harvard. Bernanke then got a PhD at Princeton, taught economics, and got into government. He publicly promoted easy money printing policies as a solution to practically everything and became the head of President Bush's Council of Economic Advisors, probably due to that factor. Then Bush tapped him to become head of the Federal Reserve Board. While Fed chairman, he helped fuel a housing bubble by keeping interest rates too low for too long. But he didn't know what he was doing. In fact, in 2006, he said that there was no housing bubble, but anyone paying attention knew what was going to happen. You see, nothing goes up forever, and when housing prices came down, a lot of people got hurt. The value of subprime mortgages went to zero, and the balance sheets of the banks owning them through leverage were destroyed. And so we had the stock market crash of 2008, and it was a total disaster. And the Treasury Department and Bernanke pushed $1 trillion bailout of the banks onto the President and the Congress. A scared and terrified public came to accept $1 trillion budget deficit, and government intervention in the economy and the stock market became the norm. As for the CEOs that ran the banks and helped create the crisis, they got tens of millions of dollars in bonuses, and the news media treated Bernanke as a hero. Then Bernanke created a program of Federal Reserve money printing called quantitative easing to create a new bull market in the stock market. That bull market has gone on now for 6 years, and stocks once again have reached bubble valuations that are unsustainable. In fact, valuation metrics such as the cyclically adjusted PE ratio have only been this high twice in their entire history. What the PE ratio does is measure the price you pay for earnings when you invest in a stock. So if a stock earns, let's say $1 of earnings in a share, and you pay $2 for it, you're then paying 2 times earnings. The cyclically adjusted PE is the 10-year average PE ratio adjusted for inflation. What you're seeing on this chart is this ratio applied to the S&P 500. Today, the cyclically adjusted PE is over 27. So as you can see, people are paying a bubble price now when they buy stocks. And some of the top hedge fund managers in history are now warning of a new crisis as a result. Over the past few months, we've seen warnings from Paul Tudor Jones, Julian Robertson, and David Einhorn, to name just 3 of them. Take a look at this. Here's Jones speaking at a TED Talk just a couple months ago, telling people that this is the greatest mania that he's ever been in, and he's seen a lot of them. One thing quantitative easing has done is create more debt for the Federal Reserve. Its balance sheet has exploded, and it cannot continue to grow like this forever. It holds dangers, and today's Federal Reserve Chairman Janet Yellen operates under the same principles as Bernanke. Now, Wall Street bankers love this, and most of Congress is silent on it, but some have started to speak out. Alabama.
The Fed's balance sheet will continue to expand rapidly. How long will this continue? We don't know. How large will the Fed's balance sheet ultimately grow? We don't know. Will the Fed be able to contain inflation if it does begin to rise? Again, we don't know. And when will the Federal Reserve, actually begin to unwind the balance sheet, which will be tricky? Again, we don't know. How exactly does the Federal Reserve plan to unwind the balance sheet? Again, Madam President, we don't know, and I don't believe they know. I raise these points because I met with Dr. Yellen in my office and attended her confirmation hearing in the Banking Committee. I received no meaningful answers to any of those questions, only the usual platitudes that so often mark such meetings.
That in turn would supposedly help the overall economy by making businesses more profits. Then they might hire more people and grow. So the whole economy would prosper. But that has not happened. There is no real recovery in the economy. You see, the economy has expanded about 1.5% over the past 2 quarters, 2.4% at an annual rate over the past 2 years, and about 2.3% during this 6-year so-called recovery. You need to see economic growth faster than population growth to see real economic growth, and that has not been happening. Oh yes, the government says that unemployment has dropped, but in order to say that, they have simply played with the numbers. Take the unemployment report for this past May for one example. The government reported that 280,000 jobs were added to payrolls that month, and that the unemployment rate was only 5.5%. The morning that report was released, Wall Street talking heads on CNBC grabbed onto that news to argue that there is a huge economic boom going on that justified the high prices in the stock market. Because they always say the stock market is going to go up because that's what they want you to believe. But let me ask you this. Do you really believe that the unemployment rate is only 5.5%? I mean, that's the type of number you see in a huge boom. And when you look around, you see no signs of such a thing in most areas of this country. Well, I am here to tell you that these numbers are nonsense, because for the past several years, the government has not factored in people who have been out of work for longer than 12 months and have not looked for a job in the past 4 weeks. It calls these people, quote, discouraged workers, and it simply doesn't count them in the unemployment rate because it doesn't want to. That way, Obama can say he is making an economic recovery. What is more, though, is that most of the jobs that have been added to the economy in the past few years are mostly part-time jobs with very low pay. Many of these people are in fact working 2 jobs and are trapped in part-time work because they have no other choice. If you factor these people in, you can actually create an underemployment rate of 10.8%, which is more realistic than saying we got a 5.5% unemployment rate. This is why personal consumption figures, by the way, were down in April and May despite this talk of a boom on television. It's also why retail sales in Christmas were so stagnant that they were the weakest in years, and first quarter GDP actually came in negative, meaning that the economy actually shrank in the first 3 months of this year. In fact, now they're talking about they want to change the way they calculate the GDP numbers to make this a positive report instead of a negative one. And these people are talking like a boom is going on. Now, most of the jobs that have been created in the past few years are low-paying part-time jobs. And I'm sure Obamacare does have something to do with that. But there's an underlying problem in the overall economy. Own hometown of Dillon, South Carolina. Now I am walking in Main Street in Dillon, South Carolina, and the Bernanke family came here and started a drugstore right on the corner of Main Street, and they actually lived on the upper level of it as it got started. Now as you walk down Main Street, you see empty stores, you see some traffic, but you also see places for sale. Walk a little further away and you see buildings deteriorating like crazy. People's houses are in disarray. There are people living with leaky roofs, and you wonder how people are even surviving. Barely in this type of economy. And when you go out even a little further, you see that this was once a productive place, but the factories have been shut down, some of them long ago, others much more recently. You also see stores out of business and entire shopping centers that are completely empty now. Here are some stats. The median income in Dillon is $14,988. The household income is $28,817. 31.5% of the people of Dillon live below the poverty level. and most of the people there receive food stamps. The unemployment rate in Dillon is over 17%. Here's the campaign headquarters for one local politician whose promise is to fix the roads. He doesn't even promise to make things better, just to fix the collapsing infrastructure of Dillon. The only thing in the area I saw that was new is this Dollar General store, where people go to buy stuff as cheap as they possibly can so they can do something to fight against the effects of inflation and low pay. The Fed money programs haven't done anything to help the people of Dillon. In fact, inflationary effects have only hurt them. Across from the Dollar General store is this loan shark building. And here's a crazy sign saying, "We buy junk cars, no title, no problem." People are selling their scrap, and I guess some are even finding ways to get junk cars they have no title for. I'm not going to ask how. I was glad to leave Dillon. Bernanke left this place behind a long time ago. But Dillon is what is happening to much of the country. But people on Wall Street have lived through a stock market boom over the past few years and don't know this is happening. To them and for the Wall Street bankers in New York and lobbyists in Washington, D.C., things have been good because they have been in a boom. And they, frankly, view people such as those that live in Dillon as dirt. All of these years of quantitative easing have achieved nothing for real in the country. But we have bigger problems than one simple Federal Reserve program. Our nation is in trouble. This did not all happen last night. It did not even happen over the past 7 years or even the past 15 years. What we are going through is an underlying crisis of politics and economics. And this all leads us to the dangers we face in the stock market today. Situation is very similar to what we saw 10 years ago. Back then, Bernanke said that the economy was fine, that real estate prices wouldn't drop, and that he had everything under control. And the Wall Street analysts you see on the television set use those platitudes to promise you future stock market gains, and we all know what happened after that. Well, these things move in cycles. And today, even though the stock market went up for 6 years and is now at a bubble valuation, Janet Yellen is saying that everything is fine. In fact, on July the 15th of 2014, she said that the market averages were at a good valuation level to invest in when she testified to Congress. She also has said in the past few weeks that the economy is picking up and about to take off, and to basically ignore all the weak economic data of the first quarter and the poor sales data of last December too. And the Wall Street people on television say that the economy is going to grow so fast from now on that the high stock price valuations will become justified. So they're telling you not to worry, to just keep believing, just like they told you back in 2007 and March of 2002 for that matter. And they repeated the Bernanke line as if it was real about real estate. And now they're doing the same thing, saying an economic boom is coming, but there isn't even a real recovery. I know that every single time you turn on your television set or read the financial media, that you're given predictions about the stock market. The thing is, no one can predict the future, and not on a consistent basis, and you cannot make investment decisions based upon these predictions or platitudes. That's not what successful investing is about. And if anyone does that, just simply bases their decision making based on predictions, at some point the predictions don't work and you end up losing money. What you need to do is base your investment decisions upon what is actually happening in the stock market, analyzing the trends in the market, and making your changes in your investment allocations when the market trend itself, the dominant trend, makes a change. Now look, I started out in the stock market in the late 1990s when the internet stock boom was going on, and I understood that these stocks were, most of them weren't real, that it was all a giant bubble. and I learned about technical analysis and charting and analyzing the stock market. So I was able to recognize when that bubble came to an end in March of 2000, and I actually shorted stocks in April 2000 for a trade. And then in the fall of that year, I started to really aggressively short stocks and made a lot of money on the downside. And fast forward to the year 2007, I had a monthly newsletter I was writing, still write it, and in November of that year, I did an entire issue saying the bear market is here because these different things are going on in the stock market. This was not a prediction I was making. I was pointing out how all the trends had come to an end and it was all changing. And that meant a bear market was coming. And people were able to adapt. We were able to adapt. I was able to adapt. In fact, in the summer of 2008, I was short stocks going into the market crash and made quite a substantial amount of money thanks to having done that. And again, I just want to emphasize again, this is not about predicting. And I'm not here right now talking to you, making this video to predict that a bear market is coming. I'm here to tell you that the market is changed, that the bull market is over, and we are at the start of a bear market. And I want you to adapt to that. I'm taking steps. I've taken steps to do that. And I don't care what the people on TV are predicting. Don't base your decisions on predictions of the future, but on the reality of the moment. And I believe we are at a moment in the financial markets, a critical moment of the kind that only happens every couple years and sets the stage for what's going to unfold over the next 3 to 4 to 5 years. So let me show you exactly what I'm talking about. The stock market moves in cycles. I call them stages, and there are 4 of them. A stage 1 base comes before a bull market and after a bear market. During a stage 1 base, the market goes sideways at a defined support and resistance price range. The stage 2 bull market is when prices continually make higher highs and higher lows. They typically last from 3 to 5 years. Now, a stage 3 topping market is what we have seen in the stock market over the past few months. It's a transition phase at the end of a bull market that leads to a stage 4 bear market that crushes people who sit and hold and hope as the market drops. Let's use the past 2 market cycles to see what I mean here. Now, okay, this is the S&P 500 from 2000-2001. Now you can tell what stage a market is in by simply looking at the 150 and 200-day moving averages on a chart. Those moving averages trend up during a bull market and act as a price support level. In a topping market, they lose their upward momentum and go sideways, and in a stage 4 bear market, they slope down and act as resistance. Now, you can see how this all worked out in the past on this chart. See how the moving averages trended downwards in the last 2 bear markets. Now, to give you a more recent example, look at oil stocks. This is XLE, exchange traded fund for oil stocks. You can see how it went through a stage 3 chop last year in the summer and then went into a collapse last fall. Is the bear market over for oil stocks? I'm not sure. At best, they're just starting a stage 1 base, and at worst, they're going to go lower again. What I do know is that they are not going to have a sustainable rally for some time until they go through a basing phase. They need to go through stage 1. That means I think we need to stay away from oil stocks for now. Now, I do plan on buying oil stocks one day in the future, but this chart is telling us we got to be patient on that and wait. So that is what I am going to do. And here's the deal. We do not need to predict what oil stocks are going to do in order to know what to do with them ourselves, because the market will tell us when the time is right. Now, it also tells us when we go into bear markets, or I should say when we start one. So look, When it comes to major tops in the stock market, there are three things that tend to happen during a stage 3 topping phase and right at the tipping point into a new bear market. First of all, you get high valuations in the financial markets. And as you know, we have that. The second thing you see is crazy bullish sentiment, as just about everyone involved in the stock market is maxed out on the amount of stock that they can buy. And when no one in the market has money left to buy, a bull market comes to an end because it depends on more buying to make it go up. We have that now, as there's now record margin debt owned by stock market investors, and investor sentiment surveys have shown wild bullish sentiment readings for over the past year. Now, the problem with these two things is that they are not really good exact timing indicators. Things have been like this for over a year with both these things. But these are good warning indicators. They come with a new bear market, but they're not enough to tell us exactly when it's starting. But the third thing allows us to see that and allows us to time things. And that is the performance of the stocks inside the stock market itself. What happens at the end of a bull market is that fewer and fewer stocks continue to go up, and many stocks go into bear markets of their own, while the market averages, the Dow, the S&P 500, and the Nasdaq continue to act fine. They seem okay. What is happening is that a few strong stocks are making the averages do good at the end of a bull market, while more and more stocks and more individual sectors of the stock market just go down in a stage 4 declines. But people see the averages on TV and just focus on that and don't understand what's really happening. What happens though is you get a tipping point into a new bear market as those few strong remaining stocks and sectors that are helping the averages follow the rest of everything else down into a new bear market. Then the market averages follow suit and go down too, and everything starts going down. And then mutual funds get smashed, and so do more people's individual portfolios as the stage 4 bear market runs its course. But the thing is, if you just pay attention to what is going on inside of the stock market, you can see this internal market deterioration take place ahead of the market averages going through their 200-day moving averages and ahead of the full-blown stage 4 bear market. And you can use a simple indicator to track this. Take a look at this. This is a chart showing you the number of stocks trading on the New York Stock Exchange that are above their 200-day moving averages in red. That's the red line. And the S&P 500 is in this chart in black. Now this is 2007. In February of that year, the number of stocks above their 200-day moving average trading on the New York Stock Exchange was at 90%. That was its peak for the year. Then look what happened. Even though the market averages went up, the number of stocks above their moving averages slowly diverged away from the moving averages and went down. That meant that the internals of the stock market were disintegrating very slowly. Then it picked up in August. What this meant was that even though the averages seemed to be okay, it actually went up into October. Most stocks and most sectors fell in a stage 4 bear markets by going below their moving averages. In August of 2007, there was a pullback in the market averages, and while that happened, the internals got smashed. The market then made a new high in October, a final high, in fact, and the number of stocks above their 200-day moving averages only got back above 60% on that high. Remember, they're at 90% in February. Well, just 2 weeks after that, the internals, the 200-day moving average, the number of stocks above the 200-day moving average quickly fell back below 45% within just 2 weeks. Well, in November, the S&P 500 and Dow and the Nasdaq all followed the internals down, and they went into a horrible bear market that lasted until March of 2009. Now, take a look at what is happening at this moment inside the stock market. Now, the exact same sort of internal deterioration inside the stock market that took place in 2007 took place again in the summer of 2015. As you can see on this chart, which is showing you the percentage of stocks above their 200-day moving average as trade on the New York Stock Exchange in red, and then in black we have the S&P 500 in 2015. The S&P 500 went up and made a peak in May. However, during that final run up in the stock market, the number of stocks trading above their 200-day moving averages trended down in a slow fashion. But after the May top in the S&P 500, the internals rapidly deteriorated inside the stock market to the point where by August, only 40% of the stocks trading on the New York Stock Exchange were above their 200-day moving averages. Now, what happened was in July of 2015, the Nasdaq managed to make a new 52-week high while the Dow and the S&P 500 had topped out in May. But what's interesting is that entire move in the Nasdaq, that final move up in July, was actually powered by about 20 high cap, highly owned tech stocks. Stocks such as Apple, Facebook, Google, Netflix, Amazon, and a couple biotechs. These stocks were incredibly overvalued. They're so-called momentum stocks that always go up. And they help push the market up for one final move. They were the final few stocks, just as they played a similar role in October 2007. The momentum, though, came out of those stocks on that final move, and they stopped going up, and the market started to trend down in August. Well, that trend down, as I do this video on August the 20th, has now completed the final transition period from a stage 3 top into a stage 4 bear market. The internal deterioration is what creates the stage 3 top, but a final price move down confirms it as the market averages fall below their 200-day moving averages. The Dow Jones Industrial Average topped out in May and fell below its 200-day moving average. The S&P 500 topped out in May, but rallied back up in July. It wasn't able to make a new 52-week high, but moved back up thanks to the Nasdaq and the momentum stocks, that the 20 so stocks that were helping the stock market in its final July move. However, momentum came out, and the S&P 500 fell back down to its 200-day moving average in August and tried to hold it several times, but then by the end of the month fell through it, and in July the 20th closed below it. Now it's trying to hold support at 2040, but with the internal deterioration that's taken place inside the stock market and this move down on high volume, it's only a matter of time now that 2040 is taken out. It really doesn't mean anything. The bottom line is the stage 3 top was played out in 2015, and as I do this video, we're tipping into a new bear market. We're basically in a new bear market. We topped out, and it's what it is. The implications for this are clear. The stock market started a bear market. This is not a prediction, it's a fact. And that means that those who just simply hold on to their stocks are going to lose money as the market goes lower. How much lower will the stock market go? Well, since 1900, there have been dozens of bear markets. On average, the Dow lost 32% during those declines. But when a bear market starts from a bubble valuation level, the losses can become massive. In the last bear market, for instance, the Dow fell over 50%. In the 2000 tech bubble, the Nasdaq lost 75% of its value. Now, there's no way to predict how big the losses will be this time, but we do know is that they're likely to be big because the valuations are starting from a bubble level. Now, I started writing about the financial markets and the stock market in 1999. And if you're familiar with what I was doing back then, you'll know that in the year 2000, I was actually shorting internet stocks to make money and helping other people do the same thing with specific recommendations. And then in the year 2002, I started going long gold mining stocks because they made an incredible bottom that year. Now, one of the things I also did during that time was I was co-managing a hedge fund for about 3 years. And word got around town what I was doing in the financial markets, and this gentleman stopped by my office around the year 2001 wanting some advice. He had a portfolio that he showed me worth about $5 million, all invested, the total thing, in internet stocks that were down 50, 60, even 70% and more. And he wanted to know, should I sell them or should I keep holding them? And to tell you the truth, most of the time in a bear market, when someone asks me what should they do with stocks they're down so much on, what they want to hear is that they should just keep holding, because that's really what they want to do. And this guy, being one of the richest people in town, was used to people telling him what he wants to hear and deferring to him all the time. Well, I looked at his portfolio and I didn't do that. I told him the truth. I told him that, look, these things are going to go lower. We're in a real serious bear market. And not only can you expect these things to drop because of that, but you can expect most of these stocks to actually go to zero because these things are total garbage. And I don't care what your stockbroker told you about them when you bought them in 1999, you got to get out because these are junk. And that's exactly what happened. Most of these stocks did go bankrupt. It was bubble and people were taken to the cleaners by some of these things that were such high flyers in 1999. Well, he got shook up when I told him this, and he didn't say anything. He just walked right out the door. And I found out that he didn't sell any of this stuff and the portfolio went to zero. Talking about a $5 million portfolio that may have even been worth 10 or 15 million in 1999. And I can bet you that I was one of the very few people who even saw this thing because he's probably so embarrassed by the losses that he didn't want to show it to anyone else. And that's what bear markets do to people. They embarrass people that lose a lot of money and humiliate them. Now, one of the other things I didn't know at the time is that this guy also had another portfolio worth about $11 million that was invested all in blue chip stocks, safe stocks. And he passed away earlier this year. That's why I don't really feel bad telling you this story because I know he's not around to be embarrassed by it. But I was told that that second portfolio in the blue chips, when he passed away, was worth about $11 million. So in other words, he didn't make money even in the safe portfolio over 14 years of investing in that. He just rode things up and down over and over again and went absolutely nowhere. Now, that's what these bear markets do to people. And it's not just the stock market. Think about real estate. That real estate bubble in 2006. You probably know people who got caught up in that thinking it's just going to go up forever, only to find themselves financially hit on the downturn and not even hit. Some people were so humiliated by it that they actually had to go bankrupt. That's how bad that was. And now here we are where we're facing another tipping point, I think, over the next couple of years. It's going to really affect people. And what people really need to do, what we need to do, what you need to do, is be a wise steward of your assets and your money and not just get caught up in what's the excitement of the past and people's predictions that is going to return. The challenge, though, is that what we've been taught is safe investing is no longer safe investing. what we've been taught is that the right thing to do is to put a portion of your money in the stock market and another portion in your money in bonds because bonds are safe. And in 2008, when the stock market fell, bonds went up. And normally in bear markets, bonds go up because interest rates fall and bonds go up when interest rates fall. So they kind of act as a safety valve in anyone's portfolio, or so we're told, and so we have seen over the years. But the challenge is that's not any longer going to be the case going forward in the next couple of years. So what's safe, or has been safe, or what's thought to be safe, is now going to become very, very risky and dangerous. The problem is that bull markets always make some people feel like they're in control when they really aren't. And it's by knowing what's happening that you actually remain in control of your finances. So in September of 2007, I got a hold of an internal Federal Reserve report that projected huge losses in real estate prices to come. This report showed me what would happen to the U.S. economy as a result. It also said that the Federal Reserve should rapidly lower rates close to zero as a result of what they thought was coming. Now, I showed this report to people as soon as I got it, so we all knew what was happening, but it was simply hard for many people to comprehend this report when they first saw it. And no one in the financial media even mentioned it, but everything in the report came true. This report was written by a gentleman named Fred Mishkin, who had been one of Ben Bernanke's best friends in college. He was on the board of governors for the Fed when he made this report. Because I read this report in September of 2007, I was well prepared for what was to come as a result. 2 years ago, this same man, Fred Mishkin, wrote another report for the Federal Reserve that projects a crisis for the U.S. bond market by 2017 and 2018 unless Congress takes severe action and starts to generate budget surpluses. This report says that the Fed's balance sheet has become so large and is so unsustainable that it will start to actually disintegrate and generate losses by 2018 and probably by 2017. If that happens, then the Fed will have no choice but to create a giant money printing operation that would dwarf what we've seen in the past and will cause the US dollar to drop in value and cause inflation to explode and bond prices to collapse. And of course, Congress has done nothing to generate budget surpluses. This gets complicated, so let me explain it to you. The U.S. government finances itself through the issuance of U.S. Treasury bonds. Remember, about 10 years ago, China was buying a lot of those bonds. Well, the size of the deficit got so big that China and other foreigners were no longer able to finance the entire deficit. So the Fed has used its money printing operations to buy U.S. Treasury bonds to bridge that gap. This Michigan report calculates that if the yield on the 10-year Treasury bond were to go above 5.2%, then the cost of financing the debt by purchasing more higher interest paying bonds would simply skyrocket and bankrupt the government. If yields go that high, the Fed would then be forced to print an insane amount of money to keep them from passing over 5.2% on the yield. It would become a total disaster for the economy and the stock market and for inflation. And this report projects that this could happen by 2017 or in 2018. Of course, some assets such as gold and commodities would skyrocket as a result of such a scenario. But those that had money invested in bonds and CDs and other seemingly safe investments would be ruined. And this would create a giant political crisis in this country. Now, I do not think that a bear market in the stock market would really have much of a negative impact on the U.S. economy, not at first. The reason why is that most people, frankly, in the United States don't have much money in the stock market. The middle class has been decimated. It got hit by the real estate drop, the crash of 2008, and the lack of recovery. and simply don't have much money anymore in the stock market. They had to pull a lot of their money out after the 2008 drop to make up for loss of jobs, to make up for loss of income, and so forth. And the poor, they got food stamps. They don't have money in the stock market. It's really the people in the middle upper class and the upper class with several $100,000 in the financial markets or more that are actually the most vulnerable segment of society right now. Because if the stock market drops, like I think it will, they're going to be the people that get hit and will have to cut back on their spending and tighten their belts like everyone else has. They'll understand what it's like to suffer in the economy and have to live through that like the rest of society has. So I know that, you know, it's not fun to see taxes go up. It's not fun if you own a small business to see more regulations and more Obamacare hit things and muck things up. And we're just starting to see the effects of that. Hasn't completely kicked in yet. But it would be a lot worse to become a complete dependent upon the state and upon the government. And frankly, I fear that's what's going to happen to many people who are in the stock market right now and have been riding high over the past couple years because of the bull market we've seen, and have not adjusted yet to the reality of the bear market that's only just starting. And these are the people that are going to get really hurt if they don't make changes and adjustments now. Not only can they save what they got, I think they can actually benefit and make money, but very few people will adjust and adapt and do that. And ultimately, I think that what we're going to see as a result of that is a political crisis in this country and riots, more riots. And the government is preparing for that possibility. You saw the Occupy Wall Street movement on television a couple years ago. Well, let me show you something. 3 years ago, I went to an Occupy Wall Street camp. They were springing up in cities all across our country. I see that I actually weighed a little less back then, and this is just a couple years ago. I'm going to make it a goal to lose 10 pounds in the next few months. You see, you got to make goals and make changes at times, and I'm going to do it. Now, I went to this Occupy camp not because I supported it, but because I wanted to know what it was about. I wanted to know what was really happening in our country, and TV just doesn't tell us that, so I had to go find out for myself. TV was saying that the Occupy Wall Street people were communists and student radicals, and they were planning attacks against the police. What I found when I investigated this for myself is that almost all the people that were there were homeless people on the margins of society. There are no college kids there. The people that were there because they had lost in the economy and had nowhere else to go. Another crisis will make Occupy Wall Street look like a picnic. Why do you think the NSA is spying on you and every other American in the United States? The truth is, not a single terrorist attack has been stopped by all this NSA spying. But the NSA will be able to track riot leaders and subversives if the shit hits the fan. The National Guard is training for riots and is prepared even to detain thousands of people in camps. That may sound hard to believe, but here are pictures from the Vigilant Guard training exercises recently done by National Guard. All it would take is the president to declare a state of national emergency to put these training programs into action. Now, I know it's hard to imagine what this would be like in real life, but these guys are training for real riots, for big riots. It's a bond crash and inflation explosion that can make this happen. What would happen if Social Security became useless? All I know is that we're in a bear market, and that means we're likely to see bigger losses to come. And you know why I'm saying this. The thing is, a lot of people won't make any changes in their portfolio. They won't make the changes that they should. And there's a couple reasons why this is. First of all, many of the people in the stock market now, they held through the last bear market while others got out. And they then saw the market come back fairly quickly. So the lesson they took from that is that holding is the right thing to do, and therefore they're going to try to ignore the losses they go through now, no matter how much it hurts them. But the thing is, I am making a mistake because they're assuming the market will come right back after this bear market's completed, like it did last time, but it probably won't. And the reason why is because we face something now that we've never faced before in the United States. And that is a bubble bust in the bond market and a bond bear market, which would be even more devastating for the stock market. It'd mean interest rates eventually skyrocketing like they did early in the late after the 1970s. And it would take a long time for the stock market to recover from that, much less ever get back to the crazy bubble valuations of the past year. So it's just like the NASDAQ. I mean, the NASDAQ didn't get back up to 2000 high until this year either, till a couple months ago. So it could take a very long time for the market to recover, no matter what happened in your experiences in the last bear market. And that leads us to a couple other things. And that is, there's another belief people have, which is similar to that one I was just talking about, and that is that the Fed will step in and print more money or do something to make the stock market stop falling and quickly go back up. Well, that's a platitude and a dangerous one to base your investment life on. And again, you can look at what happened in the last two bear markets to show you why it's so dangerous to just have faith in that platitude. Because in the last two bear markets, the market fell week after week after week, despite the fact that the Federal Reserve lowered interest rates very rapidly and practically month after month after month. They did not stop the bear market. The 2000 bear market lasted for about 3 years. The one before that, over 2 years. Devastating, even though the Fed lowered rates. So if lowering rate, they can't lower rates now from where they're starting at. So to just say, well, they're just going to print more money. Well, how, if it took them so many rate cuts just to stop the market falling last time, how many times do they have to come out and announce new money printing operations to stop this bear market? It's just going to run its course. So that's a platitude, and you can't analyze the market and make investment decisions with having faith in platitudes. You have to look at charts, you have to look at valuations, you have to look at true market trends and align yourself with that reality. And it's tough for people to do. And this is the ultimate reason why most people won't take action. They won't sell. They won't move money into things that are working. They'll just sit there and just watch their wealth drain away. I've seen it happen the last two bear markets, so I have no reason to think that is what's going to happen to most people again. And what I saw people do in the last two bear markets, a lot of people, was just be too afraid to make a decision. Television told them the market's going to go up. This is a bottom. Every time the market has an update, someone will come on TV and say this is the bottom. So people have a hard time not doing what TV tells them to do, and everyone they know just about is going to sit there and just hold and hope and hold and hope week after week as they lose more and more money and not do anything. So they won't know very many people taking action. And most people just kind of do what their friends are doing or do what their television's doing, because deep down, the average person is really a conformist. It's the rare person who's able to step outside of those type of psychological pressures and the fear of doing something that everyone else is not doing and then having them look at you and laugh. So many people rather just stay with what everyone else is doing, even if it means losing everything they got. And that's why these bubble busts and bear markets are so devastating, and why you've got to get out of that trap. You cannot be afraid to take control of your own finances, to take control of your own destiny, and be someone that is afraid to be like everyone else and lose. In moments like this, you've got to step out of the stands, walk into the arena, and look at the crowd up there and see them for what they are, and become a person of action in the stock market. Because it is those type of people that in the long run generate true wealth out of the financial markets, and that's what I want you to do. So this is not something to be afraid of. A bear market is not something to be scared of. A bear market is something that actually can become a massive opportunity for you to make money, while most people you know are just going to suffer that are in the stock market and possibly lose it all, and then come out of this just making an absolute killing to be able to buy when it's all truly at a bottom and turning around to make money before that even happens. So that's your opportunity. And this also, maybe not today, it doesn't seem like it, and it won't seem like it next week, but we do seem to be approaching a dark time in our country. And just as the stock market moves in cycles, so does politics, and so does history. And this can be a personal moment of greatness for you, and it also, eventually, as this crisis plays out and the country comes out of it, it can actually end up becoming a time of renewal for this country. But for that to happen, we must all do our part, including you. We must all carry forward the principles that founded this country, that built this country, and pass them on, share them with people we know, and keep them alive. And that's your responsibility and mine. And if you don't do it, then we're just going to continue down the road we've been going the past 20 years that have brought us to this point where we're walking off a cliff, politically in this country. But what's going to happen is, as we approach that cliff, eventually at some point people will see what it represents and what's on the other side of it, and they'll listen and turn around. But it won't take a single voice making that happen. You will have to do your part. Look, you have nothing to fear but inaction. There is nothing to fear from a bear market if you see it coming and have the foresight to react to it. And even a bad economy isn't necessarily something that should make you quiver in fear either. The worst this country has ever seen was in the 1930s during the Great Depression. But there are actually people who built businesses during that decade. That's the decade that Hollywood took off. That's the decade when the Sears, Roebuck and Company went beyond its catalog business and started opening up stores across the country. That's the decade when a man named Michael Cullen started a supermarket chain called Kroger's. People told him that the economy was bad and he laughed at them because it didn't even matter when he had the foresight to take action. The 1930s were also a decade that a man named Paul Getty inherited $500,000 and then bought oil stocks using that money near the stock market bottom and then went on to become a billionaire. The 1930s were also the decade in which Howard Hughes made his first fortune. These men did not give up. And as you know, there are people who shorted the stock market during the last two bear markets that made fortunes too. It's all about aligning yourself with the dominant trends of the market, aligning yourself with reality instead of platitudes. And even in bear markets, there's a few select sectors and even asset classes that buck the bear trend that's dragging everything else down and go up on their own. And that's what we need to focus on in the next couple years here. And I want to do everything I can. I want to pledge to do everything I can to help you during these times, because we are really in this situation together. Me, you, and everyone else that's invested in the stock market or has investments, period. And we're going to be watching this situation unfold now, day after day, week after week, and month by month, and working to find ways to adapt, adjust, and ultimately profit from this. And I will share with you what I think is going on in the markets and where we can do just that in future updates. So stay tuned for more stuff from me, whether it be videos or emails or posts on the website and so forth. And I'll be talking with you later.